One move on this list is quietly worth $203,161. It's not investing more. It's not earning more. And millions of people are on the wrong side of it right now. We're counting down 7 money decisions where the math will genuinely surprise you. Every number is real. Every comparison is exact. Stay to number 1, because that's where most people are leaving the most on the table. Let's kick off at number 7, and it's a quick win hiding inside a frustrating problem. If you're carrying $10,000 in credit card debt at a 23% APR, here's what happens if you just keep making payments without changing anything. You'd pay $2,264 in interest before it's gone. Now flip the script. A 0% balance transfer card gives you 18 months with no interest at all. There's a transfer fee of 5%. That's $500 out of pocket up front. But with a monthly payment of $556, you clear the balance inside those 18 months and pay 0 interest. Total cost, just that $500 fee. Your net savings? $1,764. That's real money recovered from a decision that takes one afternoon to execute. The catch is discipline. The 0% window closes. Miss it, and the savings disappear. But if you're carrying high-rate card debt right now in 2026, this is one of the fastest math wins on the list. Up next, number 6, 2 accounts that accept the same dollars, but one of them quietly does something the other can never do. Number 6 is about 2 accounts most people treat as interchangeable, and that mistake is expensive. An FSA and an HSA both let you set aside pre-tax money for medical costs. But there's one enormous difference. An FSA is mostly use it or lose it. The maximum you can carry over is $680. An HSA, it rolls over every single year, and it can be invested. Here's what that looks like in practice. Contribute $4,400 a year into an HSA. Let it grow at 7% annually for 20 years. By the end, that account is worth $191,006. Your total contributions over those 20 years? $88,000. The growth alone, $103,006, is money the FSA path never produces. The total HSA advantage compared to an FSA over that same period is $190,326. Same dollars in, wildly different outcome out. The HSA only works if you're on a qualifying high-deductible health plan. But if you are, and you're using an FSA instead, that gap is the price of the swap. Number 5 is another account comparison, but this time the gap shows up at the very moment you're ready to spend the money. Number 5, same investment, same time horizon, 2 very different endings. Invest $750 a month for 20 years at 8% growth. In a taxable brokerage account, your ending balance is $402,501. In a Roth IRA, it's $441,765. That's a $39,265 difference. And here's the key. 100% of that Roth balance is yours, tax-free. The taxable account gets hit with capital gains tax when you withdraw, currently 15% for most people, which is exactly what shrinks that number. The Roth's tax rate at withdrawal? 0. For 2026, the contribution limit on a Roth IRA is $7,500 for those who qualify. The account isn't magic, the tax treatment is. You're investing the same $750 a month either way. The Roth just doesn't hand a cut to the IRS on the way out. Over 20 years, that difference compounds into $39,265 you either keep or don't, based purely on which account holds the money. Coming in at number 4, here's the part that breaks people's intuition. Most assume waiting always wins with this one. The real answer is more complicated. Number 4, and this is the one that genuinely breaks people's intuition, so pay close attention. Social Security. You can claim at 62 and get $2,000 a month. Wait until your full retirement age of 67. You get $2,857. Wait until 70. It jumps to $3,542. Most people assume waiting to 70 is obviously the best move. Here's where the math gets complicated. Run lifetime totals and the picture shifts. Claiming at 62 produces a lifetime total of $734,026. At 67, it's $767,494. At 70, $762,179. Actually less than 67. Now factor in 2.5% annual inflation adjustments over time. and the inflation-adjusted lifetime totals land at $552,000 for age 62, $617,112 for 67, and $637,560 for age 70. Waiting to 70 still wins on a long enough life. The break-even age is 85. If you live past 85, the $3,542 monthly check pulls ahead. But millions of people are in worse health, have shorter life expectancies, or simply need the income earlier. The always wait rule isn't a rule. It's a bet on your own longevity. Number 3 doesn't require any account or any decision. It's been happening to your money this whole time, whether you noticed or not. Number 3, and this one is already done to you. Inflation. Take $1,000 from the year 2000. To buy the exact same things today, in 2026, you need $1,900. Prices have risen 90% since then, which means the original $1,000 has lost 47.4% of its purchasing power. Nearly half gone, not from a bad investment, not from a fee, just from sitting still. The multiplier is 1.9, meaning a dollar from 2000 now costs $1.90 in 2026 dollars. This is why a savings account paying less than inflation isn't actually saving anything. It's a slow, quiet loss. Most people track their account balance and feel fine, but the balance isn't the real number. Purchasing power is. And for 26 years, inflation has been the silent tax nobody voted for and almost nobody tracks. Everything else on this list is about gaining. This one is about stopping the bleeding first. Number 2 is about a tiny daily habit and what it quietly adds up to over a very long time. Number 2, this is the small number that turns into a big one. $5 a day. That's $152.08 a month. If you're 25 right now in 2026 and you redirect that $152.08 every month into an investment account earning 8% annually, here's where you land at the end of 30 years. The account hits $226,654. Your actual contributions over those 30 years total $54,749. The market did the rest, $171,905 in gains on top of what you put in. That's more than 3 times your contributions, generated purely by time and compounding. There's also a milestone worth noting. The account crosses $100,000 well before the 30-year mark, and then the compounding accelerates from there. The $5 a day habit isn't the point. The habit of investing consistently is. The dollar amount matters less than the timeline. Start at 25. The math works hard for you. Start later. You're doing more of the heavy lifting yourself. And now, number 1, where the biggest gap on this list is hiding inside something most people think of as the responsible choice. Number 1, and this is the one that genuinely costs people the most because it looks like the right move. Whole life insurance versus term life insurance. Whole life runs $450 a month. Term life for the same coverage, $60 a month. That's $390 a month difference, or $5,400 versus $720 per year. Over 20 years, you've paid $93,600 more for whole life than term. Now ask a different question. What if you bought the term policy and invested that $390 monthly difference at 7% annual growth? After 20 years, that side account is worth $203,161. The market growth alone on those contributions is $109,561. The insurance industry frames whole life as an investment, but the investment you're making is in their product, not in your own account. Term covers the risk. Investing the difference builds the wealth. The $203,161 gap is what that confusion costs over 20 years. That's number 1. And it's the most expensive, responsible money habit on this entire list. We started by asking what a single money move was worth. And the answer was $203,161, hiding inside a bill most people think is responsible. If this changed how you see even one of these decisions, follow for one money twist a day. Next up, we're running the numbers on another move everyone assumes is smart. And the gap is just as jaw-dropping.